So as per usual instruction, whenever it's a non-farms morning, I think you just need to be a little bit realistic about what you're probably going to get out of the morning session, in regards to the fact that, generally speaking, any larger kind of institutional flow, anything of that nature, larger order size, tends to just sit on the sidelines and wait for the jobs report. You can see that with the exceptionally narrow range you've had overnight in the S&P, very much just finding some resistance around that R1 level. Likewise, the DAX, moderate gap up in the futures open, and it's again found some respective resistance around that R1 as well. This follows on from a slight positive close in the S&P, so turnaround from the consecutive lower closes that we had seen, up only marginally, though, about 0.1%. Pretty flat for the Nasdaq and the Dow, though. In Asia, mostly higher, following on from those minor gains. Strength in healthcare and financials keeping the indices afloat, and for the ASX 200, the Aussie index, which does have a lot of financial names which make up as a large proponent of the index, helping buoy that index as well. The Nikkei, as you can see from the Japanese yen, has weakened overnight, so dollar yen then consequently moving higher, psychologically just testing around that 115 handle. Just quite interested to keep an eye on that one, given that that's already at the R2 level, coinciding with the 115 handle. So any further break on that might see a bit of an extension, but that usual correlation, the weaker yen supporting some of the export specific names in the Nikkei and helping subsequently lift the index. So moderate risk on tone overall. One thing that does jump out at me when I'm looking at the charts here, top left, is obviously the euro. So still remaining somewhat buoyant this morning in the wake of the ECB interest rate decision and press conference yesterday. So we're actually up retesting as I speak around the highs this morning from the kind of initial snap and the high print that we had during the press conference itself. That was printed up at 106.65 and a half. So we've pretty much got close to that before finding some resistance here, this last turn lower. Above there, obviously sitting on the daily pivots, the R1 just above. So a level to keep an eye on as we go forward. Just quickly then, taking a look at the euro currency, I just wanted to quickly recap the ECB interest rate decision, because I thought it was quite an interesting one to trade yesterday in regards to some of the movements that you saw. So if we just go through the event chronologically, and starting off with 12:45, that was the initial interest rate announcement. Now, when you talk about the main three interest rates at the ECB, no one was realistically expecting those to be changed, but there were some very outside bets about, what if they made some movement on the deposit rate, i.e. moving it up from its current negative 0.4, what if they were to decrease the size of the monthly purchases, all very extreme outside probabilities, but nonetheless a possibility. Or when they released that statement at 12:45 with the rates, it does have some accompanying text. Is there some subtle tweaks in that? None of which of what happened, and so any of those looking for some kind of more hawkish twist didn't get that, and this is more, this downtick here, an unwinding of some of those outside bets that something might have occurred. So you get that little snap lower there. That's unsustained though, because realistically the move gets paired in the minutes thereafter, because ultimately no one was really expecting a change here. This is just an unwinding of some of those moves. Then we go into the actual event, and it was quite an interesting in the first couple of minutes, because as I was saying in the preview going into the event, often with the ECB what you tend to see is the first couple of sentences from his opening statement tends to give it away in regards to how hawkish or dovish the actual event might be. And actually we got a few mixed signals, because originally, well, if we just flick over the charts to what I'm going to call smug draggy, Euro jumps as ECB declares victory against deflation. Obviously one of the things in which has not happened through this period of the last few years in Europe, even amid this ongoing QE program, is there's been a lack of inflation. And so just a couple of the charts here just to quickly show you. This was the one we were looking at yesterday about Eurozone inflation. is at the ECB's target level for the first time in 4 years. You can see how it really has come ramping back only within the last kind of quarter of 2016, and then to where we are at the moment, back to that 2% level. The thing, though, that caused the market, I think, to, at the beginning, move lower to start with was that at the beginning of his statement, he didn't really say too much that I thought was particularly new. And in particular, when he talked about inflation, he said that core inflation, ex food and energy then, remains subdued, which actually is the case. Now, although inflation's gone up, if you X out some of those more volatile components such as energy and food, inflation actually, as you can see here in the bottom chart, has been relatively unmoved and still remains quite depressed. So as such, actually you did see the euro start to come under a bit of pressure in the initial move, only to then be reversed quite quickly. Really though, the bigger move came as the statement progressed and as he went through the Q&A, because there's a few other highlights that did come out. One was the economists, they did revise up their Eurozone growth forecasts. They also did the same for inflation, albeit that was largely expected. I think they bumped up this year to something like 1.7, I think it was, from 1.4. But here's really what I'm looking at here, and this is the words that Draghi used. And this is something which the newer guys you'll get more accustomed to the more of these press conferences you hear, the more statements that you read, and over time it's these real subtle changes that make all the difference when you're trading these events. And really the two main areas that did change, and if you were to put ECB guidance into 5 categories as Pictet Asset Management have done here, you've got the balance of risks, and that's measured by 2 key metrics, growth and inflation. So you'll see a familiar pattern here forming amongst all of the central banks globally. Like the Bank of England in their quarterly inflation report, we define policy expectations upon projections on growth and inflation. It's the same with the ECB. Then you look at their broader stance, policy rates and quantitative easing, which of course is a key proponent of policy at the moment. Now you can see that on the balance of risk for inflation, policy rates and QE, there was actually no change in those specific wordings. However, there were changes for the balance of risk to growth. Previously, in January, their last statement, they said tilted to the downside. In yesterday's statement, they said risks have become less pronounced, but remain tilted to the downside. So it's that simple addition of those 5 words that has actually changed the context to be less dovish. Still dovish in a sense that they're still tilted to the downside, but almost moving, if you like, the needle slightly more centre from being so left-leaning to being more dovish as their normal stance. If you look at the broader stance, and this is the important one, they previously said a very substantial degree of monetary accommodation is needed. If warranted, the GC, the Governing Council, will act by using all the instruments available within its mandate. Now that quite chunky statement got reduced to just a very substantial degree of monetary accommodation is needed. So importantly, they've dropped this last or second half of that statement. So they've dropped the part that said using all instruments available within its mandate. So you can see just on those 2 simple words or sentences, part 1 at the top on the balance of risk for growth, and then 2 on the broader stance, they've made a fundamental slight move towards being, I wouldn't really classify it as hawkish, but being quite optimistic about the economic environment going forward, leaning them to move slightly away from such an accommodative stance. And as we discussed here yesterday, what Deutsche Bank were looking for was this kind of gradual evolution of a less dovish policy stance that will occur over the months ahead before the unwinding of things like QE and an eventual rate rises, which are priced at this point to come in the summer of 2018. So overall then, when we start to, let me just have a look. This is what I was talking about with these categories here. When I was just talking about the different subsections of ECB guidance. So these were the 5. This was the 2 sections that had changed, which was growth and the broad stance. And you can see here, just to recap if I wasn't showing my screen then, this is how this paragraph changed to drop then down to this, which is Xing out the instruments available in its mandate. And then also on the growth side, they've introduced this statement of risks to become less pronounced. So hopefully that kind of makes a bit more sense then why the market perceived, as the Q&A went on, this announcement to be less dovish, i.e. then leaning on the hawkish side. They also, you can throw in other statements about positive broader economic developments and recovery ongoing, and then the fact that they have not discussed any new TLTROs, which is those targeted long-term refinancing operations which are beneficial for bank stocks. And so then, as it progressed, we continue to punch higher in the euro currency. So hopefully that explains the ECB. And if I look at the euro chart, just going back to here we are at the moment, quite an interesting level that's provided some resistance. We're back up there as I'm talking now, having a retest, so you can see here on that 106.65.5 level. So keep an eye on that. Likewise, the general optimistic tone from Draghi, I would say as well, probably another factor just keeping these European equities buoyant this morning, following on also from the higher close, albeit marginally, on Wall Street and Asia overnight. So the DAX also on the front foot this morning. Consequently then, amid that risk, moderate risk on, you're seeing gold has broken that 1200 we had yesterday. We were keeping a close eye on that level. Didn't quite get there in the European session. We had a brief flirt about $1 away from the handle before it bounced and then kind of settled. It was only until really late on the Wall Street close that we originally busted through the level. Had an immediate look at S2 before bouncing. You can see how psychologically that level is important. Even just looking here on the initial break, the price action runs lower. It then bounces off the S2. You can see then it comes back to then provide some support to that initial candle before then breaking down again. And then another potential classic short opportunity then on this move that occurred overnight during the Asia Pac session. Europe comes in, they interpret the move, hit it again, and you can see we're just coming back up now and toward that S1 level. So again, maybe another opportunity if this risk appetite is maintained, then potential for continuation of that downward trend in gold, which has been a predominant theme throughout the whole week, especially given the strength of the jobs data. Obviously, we had an ADP on Wednesday, which leads us into non-farm payrolls coming up later. Okay, quick look at some other stories then, just to wrap up the news overview. And this is an interesting headline that I've seen, I saw last night, in regards to a lot of the conversation or the topic of conversation from yesterday, which was about shale industry. And yesterday I was talking about, through the advancement in technology, the efficiency of US rigs has increased exponentially over a very short period of time. And actually thinking about this time last year when oil was down a sub $30 handle, and we were looking at basically OPEC looking to squeeze out the shale industry, to almost bankrupt it, if you like, to bring it beyond the point of break even. It seems as though that argument in such a short space of time is completely reversed. And what's happening now is that this previous kind of benchmark level up at around $60 that would make shale production viable has now dropped essentially in half. And a lot of these major firms can now operate down as low as $35-40 bucks. And that, in comparison to the Middle Eastern names, i.e. OPEC and even non-OPEC giant Russia, that is to the detriment then of their fiscal policies and being able to accommodate their budget requirements and so on, because they would need oil pumping it or priced at a much higher level. So the key thing here then, we've come to this juncture about a bit of a game of bluff. The US, as we saw with the DOE oil inventory numbers earlier this week, US output is continuing to ramp up at quite an aggressive pace over the last week-to-week period, up 0.72%. And we're at a level which is pretty much back to before the China crisis we had at the beginning of 2016. everyone now is talking about the 10 million marker barrels per day production from the US. That would put them as the biggest producer on the planet. And so that, in combination then with Trump looking to make that even more accessible via licensing in order to promote self-dependence, if you like, and also with that introduction of that law only recently in the last few years about the US can now export crude to foreign shores as well, means that it's going to be interesting to see whether OPEC are going to buckle under the pressure, and if prices continue to go lower, then let's say shale industry can afford to let it go down to 35. At what point is OPEC going to have to, the US going to force OPEC's hand to have to keep cutting in order to keep the price up towards more this kind of $50, $55 handles that we've been more accustomed to in the last month and a half or so. So interesting was this article. Last night the Saudis have said they've told the US that OPEC will not extend cuts to offset shale. So if you remember, Zero Week has been ongoing in Houston all week in the US, and this is where all the major movers and shakers, both from the corporate scene and also oil ministers and energy ministers from across the globe, are all there. So if anything's going to come out of any significance, all the major people are there at that event. And essentially the senior Saudi energy officials have told top independent US oil firms in a closed door meeting this week that they should not assume OPEC would extend output curves to offset rising production from US shale fields, according to two industry sources. So this is quite interesting because this is going to be a real thing to keep an eye on for oil traders going forward in the months ahead, is that how much of this from Saudi and the Middle East are idle threats. The US seem pretty steadfast that their internal consumption is probably going to go up. Economic growth is on the increase in the US, as we're seeing from the economic data. The US economy is improving and outperforming in much respect across the global economy. And also you've got this fiscal element to come in potentially from the Trump administration over the next 2 to 3 year horizon. And also then the exporting of their crude. So for energy, for the US, they've really got nothing to lose. OPEC have got it all to lose, having had such a monopoly over such a long period of time. So it's interesting to see the Saudis. To me, this is the first sign of them. This is them getting a little bit desperate, in my opinion, and I don't think this is going to detract the US from doing what they're doing, and that's ramping up oil production at a very rapid pace. So it's going to be interesting. I think at some point, though, I still say you're going to get potential for source comments to come out, or the likes of Russia and Saudi will start, if this price starts getting down to kind of mid $40 handles, then talk of action, further action to come, I would say, is probably going to come as verbal intervention will look to then squeeze prices back up, as we've seen in the past. The only thing is, if they keep doing that, that's almost playing into the US's hands, because then the US can say, right, we're going to keep on pumping, OPEC can keep on cutting, that means we all just make more money in terms of the US. It's kind of a win-win situation in the US at the moment. The phenomenal turnaround in terms of how quickly that technology's come on. Okay, a few other things just to be aware of. We've had German trade surplus shrink to a 12-month low this morning. So you can see here on the chart that is actually quite a big change from where we have been more recently through the period of 2016. It shrunk to its lowest level in a year on the back of a sharp climb in imports at the start of the year. This is the German imports, what it looks like over the course of the last several years. You can see actually imports are quite high, and that is a sign that consumer demand in Europe's largest economy has got off to a robust start for the year. So German data, obviously we've had a couple of mixed signals. Factory orders was very poor at the beginning of the week, but industrial production was quite strong, and now you've got imports on the rise. So something to keep an eye on in Germany. Another headline you've probably read this morning, a second Scottish independence vote looking inevitable, with ministers concluding it's a question of when, not if, a vote is called. And so the Scots continue to put the PM under some pressure, but people close to Theresa May's office have said they expect the Scottish First Minister to seek a referendum next autumn, but that the government would fight to delay the vote until after Britain leaves the EU, because likelihood this is only going to complicate and distract the government from its task at hand after triggering Article 50 of its negotiations with Europe. If they're having to also deal with a Scottish referendum, it's only going to make it more difficult to get the job done, if you like, when negotiations get underway. Finally, we've not really talked about it much this week because really it hasn't really been much of a market mover, but I've seen some quite interesting graphics about the French election. So Marine Le Pen, victory path remains narrow despite fading anti-right front. And the graphics that I've seen that I think put this into quite good context is this one. Because this here, on the left-hand side, you have the first round voting intentions. Remember, it's a 2-round voting system. You've heard those polls like Opinion Way come out where they've had first round with all the candidates and then the second round runoff, which is basically the final between the final 2 people in the presidential vote. Now, what's interesting about this infographic is that these are the kind of 5 main potential candidates, and according to the latest polls, you can see here Marine Le Pen, as she has been for most of the period, is likely to win the first round, but only by a marginal degree over Emmanuel Macron. Now, the interesting thing about this graphic is it shows then, when we go into the second round, where, and what I'm looking at here are the 3 at the bottom: François Fillon, Benoît Hamon, and Jean-Luc Mélenchon. Where did their votes go? So if you look at someone like Hamon, who's the leader of the Socialist Party, obviously very few of those votes. If Hamon does not go through, socialists aren't going to vote for the National Front. It's probably highly unlikely, as you can see here, defined by only a very small proportion. The majority of that will go to Emmanuel Macron. Then you look at François Fillon, and actually it's a bit divided, because ultimately both Fillon and Macron lie as a centrist view in terms of their policies, albeit one leaning right, the other leaning left. But for many, going to the National Front would be too further far right leaning. And so yes, that will capture a proportionate amount of the Fillon vote, but 50% of that, if you extrapolate out the abstention, would go to Macron. Then you have Mélenchon, and that will likely as well, most likely, go to the camp giving more left-leaning to Macron. This is why Marine Le Pen's chances when it comes down to the second round, it's highly unlikely that she'll win. Because if you have a look here, that in the first round, yes, she's dominant, but only by a marginal amount. And Macron then, because of the more centrist view, the kind of more leaning left have no other alternative but to support Macron, other than if they don't vote. One thing then that means is that the turnout is going to be very important. One quite interesting statistic that I saw, which is actually quite different from what we had with Brexit, was that I was looking at Le Pen is actually the favourite for younger voters. Now, if you think about Brexit, it was kind of a sliding scale between the younger you were, the more likely you were to vote to remain. The older that you got, the more likely you were to vote to leave. Whereas what you're seeing in France is that actually Le Pen has captured a phenomenal amount of support for the younger age group. Le Pen for 18 to 24-year-olds is by far the most popular. Whereas if you look at Fillon, actually that starts to get 64 plus, much more support. But Macron is pretty steady across all of the age groups, which actually could be to his benefit, I guess. If you're looking about someone who isn't willing to go as far as the National Front, then he's a more centre choice, if you like. I'll post this article in the chat for those who want to have a read, but turnout is going to be really important. I did see a very interesting statistic actually here, is that looking at the National Front, they've never taken more than 6 million votes in any national election. And previously, their historical let's call them voting electorate, has always been of the same view. People who are at the, I'd say, far left or far right of the political spectrum are unlikely to move. The swing states, or the voter who sits on the fence and that tends to move with centrist leanings left or right, these guys who are at the most furthest extreme very rarely are going to change. You're not going to have someone who's a socialist just jump into the far right camp and so on. So therefore, it does make it hard to see how historically the National Front have very rarely deviated in their actual following. And they've never taken more than 6 million votes in any national election. So Le Pen needs more than 15 million to win in the second round, assuming a turnout of 65%. So in essence then, Le Pen needs to double her number of supporters. Now, yes, she's probably going to, because of the populist movement, gain some political traction. But can she more than double her following? These are question marks that mean that it's going to be a very... it's almost, according to most people, who, whether pollsters, economists or analysts, and whether you believe their insight or opinion is worth any credence, a Le Pen win would be much more surprising than Brexit and Trump, even though the market from an emotional, behavioural point of view has probably got more desensitized to the what-if scenario occurring. Actually, when you look at the mechanics of the voting system, the polling, you layering the statistics as well, the Le Pen win is less probable and would be much more of a market surprise if that were the case. So again, something to keep an eye on. Let me just quickly bring up the latest opinion poll, or the Opinion Way poll, which is kind of the benchmark that the market's looking at the moment. And you can see here the runoff still quite clearly between Macron and Le Pen. But as you can see here, Macron has started to take a further lead here, 64 to 36. And the wider this goes, the more kind of risk on you're probably likely to see, as the probability then of a Le Pen win reduces. Okay, quick look at the day ahead. You've got at 9:30 some UK data, manufacturing, industrial production figures, so sterling traders, be aware. Trade balance, construction output, all coming out at the same time. I wouldn't say any of these are as important, say, as something like service PMI, but in combination, likely to add some volatility. Given though that there's variable numbers coming at the same time, just be a little bit careful of getting chopped up in some of the initial noise. If it's all unilateral, if you like, in direction, i.e. all good or bad, that might provide a bit of movement. But obviously the focus today, and to keep things realistic in the morning, just be aware that it does usually tend to be quite quiet in the morning session ahead of the main event, which is the US non-farm payrolls number. Now, payrolls at the beginning of the week, I would say, was a really big deal for the market. It was kind of one of the final pieces in order to really cement in not just a March hike, but how hawkish might the Fed be in their statement of communication thereafter, i.e. how many hikes and when they might come. But what's happened is you've had ADP earlier this week, and ADP's kind of almost set the scene for what you could be looking out for with the non-farms reading later today, because last month we had a very strong ADP and we had a strong headline for NFP that followed. They were fairly well correlated. Well, ADP on Wednesday this week came in at 298,000. That was way above expectations of 190,000, so it was over 100,000 higher than expected. Sorry, Vas, do you mind closing the door for me? Thank you. So 298,000, just shy of 300,000. That puts this as the biggest job gain that we've seen in this particular data set since December of 2015. So non-farm payrolls is kind of prepped up for a good number today. The only thing is, remember, it was the underlying wage numbers that basically were weaker in the last payroll report. So remember what happened last month? You had the initial snap reaction in the market, interpreting it as a good report, i.e. US yields spiked up, the dollar spiked up, only to be reversed pretty much instantly because the underlying metrics were weak. So again, we'll talk about how to trade around non-farms later. But looking at the actual figure itself, it was 227 last time. The estimates currently, I think, have been bumped up slightly. I've got on my calendar here 190. Likelihood is the market's going to be positioned, so the whisper number will probably be in excess of 200, I would imagine, of how the market is positioned. Okay. I've just seen a stranger walk in. Still just wrapping up, Piers, the morning briefing.
Oh, yeah.
Do you want to come and quickly say hello to your followers on the camera?
Yeah, absolutely.
Well, you can. Still recording.
Hi guys.
At the moment.
Good to be back. Been away from the desk for a while, so been out in Shanghai this week. But good to be back here, and yeah, just trying to. Obviously, I'll be catching up on events. Looking at this key top on euro dollar from Draghi's sort of ECB event yesterday. Interesting to see oil. I know Ant's probably spoken about this, but yeah, it'll be interesting to see what happens now. For me, I was certainly of the opinion that oil would be tracking between $50 and $55 for most of 2017. So now my theory is about to be strongly tested. You know, I was certainly open for a move outside of that channel, but that would only be temporary. That's been my opinion. Now, we're obviously outside of the channel on the downside, so it's going to be interesting now to see whether I'm right, and whether these shale producers can actually continue to ramp up production. You know, has their cost point dropped sufficiently to see production rise steadily towards 10 million barrels a day this year? If so, maybe there's a chance for further moves to the downside. But then how would OPEC respond? So, yeah, interesting. I think the next week will be very important for my medium-term view of oil staying in the 50 to 55 range. So we shall see. But yeah, looking forward to payrolls this afternoon. Punchy, to say the least, on ADP. So let's see. And if we get a big one, then you know that March hike next week looking locked in. Oh, it's now 100%. Wow. Okay. When last time I was at the office, it was 80%, so we're now 100% for next week. Interesting times. Right, well, I'll let you guys get on with it. Enjoy the session. Thanks.